I'm Bambi Francisco for Vader TV, the network for innovators, and I'm speaking with Matt Ridenour. He's the co-founder of Momentum Venture Management. Matt, thanks for joining us.
My pleasure.
Flying up to San Francisco from LA.
It's an easy trip.
Okay, you and I were talking a little bit earlier about why you started your company.
Right.
And essentially you believe that the venture capital industry sector is broken. So explain a little bit
about
that.
Well, first of all, we founded the company more than anything out of a love for entrepreneurs and innovators and early stage work. My partner and I were thinking of launching a venture fund in sort of 2002, 2003. And as we thought about the model and what actually happens, we kind of reflected on what was going on in the markets where we were interested. And what was happening is there were lots of great ideas, more great ideas than ever, lots of entrepreneurs. At the same time, you go out and talk to venture capitalists, and they would say, there's no deal flow, we don't like the deal flow, there's not enough that's qualified. And
there's a lot of deal flow, just not their type
of deal flow, or not qualified yet. Right. And I think what's happened in our view is that folks that did very, very well early on investing $20 million in $2 million chunks or making $1 million investments and helping entrepreneurs grow up, as they had success, they got a bigger and bigger fund. Mm-hmm. And if you're managing $500 million, you can't deploy $2 million. In fact, we were helping a company recently, and a venture capitalist said to us, if you could give me a bond for 35% a year, I still couldn't do this deal because I can only get $3 million to work.
Right.
And so, we looked at that dynamic and said, we got to get in there and figure out a model to help entrepreneurs get out of the garage with their technology and up to the big leagues. And,
it is a shame that these large funds that require the managers, the general partners, to actually look for deals where they can actually put millions and millions of dollars in, and there are a lot of companies out there that really don't need that much. I mean, what is when you look at a deal, you're coming in at a very early stage. Are you looking for them to be, the exits to be a $20 million acquisition, $30 million acquisition?
It's a good point, and we're a little bit schizophrenic about that, to be honest. I think on one hand, our ultimate partner is the venture capital community, and that's probably true with about half of our deals. We want to help the entrepreneur get traction, get a business together. We operate as executives, as you and I have discussed, and we get in there and do the groundwork, and then take it to the VC when it is something that can take in $5 or $10 million. And so those are models where we vest into our equity, and we hand it off to our partners in VC. We help them recruit the right team, and we hold on. And then the other part of our work is, yes, companies that can exit for $20, $30, $40, $50 million. And between us and angel investors and others, maybe we've put in a couple, $3 million, and we've got a wonderful return. You don't have to have a $1 billion company to have a 10x investment or a 20x investment, right? Right.
So you've been doing this for about over 3 years.
Yeah,
since
3 or 4 years now.
So how many companies have you actually been able to get to that VC fundraising milestone, and how much have you raised for those companies?
I'm trying to think off the top of my head what the number is. I think it's around $35 million in total capital has gone into the companies that have gone all the way through the process. We've got 14 companies now that are either all the way through the process or...
The process being raising Series A?
More extensive than that. We're all former consultants. We're all former early-stage CEOs, and some of us have actually been venture capitalists. So we designed a process where we start with some really intense due diligence, the kind of diligence that folks would expect to go through in a VC process. Then we go through a 6-month, typically 6 to 9 month execution phase, where we come in as an executive team. We bring outside resources, we come in ourselves, and we actually execute the plan. We get customers, we finish the technology, and we get it to the point where it's investable.
Just so the audience, the viewers know, you actually come in early on consulting, and that's about $15,000, $20,000, and then you determine whether you want to go on and invest in the company.
Yes.
Okay, so go on.
Yeah, that phase 1, as you mentioned, we really view it as, because we go at risk, after that point, most of our compensation, almost all of our compensation is at risk for success. We want that entrepreneur in the beginning to kind of indicate their seriousness about moving forward. So we take $15,000 to $20,000 typically. We kind of lose money on it, but it's important for us. And we develop a plan.
Sure.
And it's that plan that forms a basis for our partnership. If they say, yeah, I like it, it sounds good, we like it, we jump in.
What type of entrepreneur are you looking for? Because you're really basically coming in a very early stage, but you're also kind of booting out the one with a vision. If you come in at the executive level as CEO, I mean, is that, I don't know, what's the profile of the companies you're typically working with and the profile of the entrepreneur you're working with?
Well, booting out would be a terrible
well,
terrible
some of
way
them
to
may
describe
not want to be a CEO, but, you know, some...
Well, no, I'd say, you know, our best references, I mean, the people that just really rave about us, and I think, you know, probably 100% referenceable at this point, are the founders. And so, you know, but you raise a good point. I think that the typical founder we work with is a technology founder.
Sure.
They've got a vision, right? And they've probably been playing the role of CEO, but they've probably been playing the role of CEO, CTO, head of sales, janitor, right?
Everything, yeah.
I mean, we might be become involved when there's 2 or 3 people, very early.
Okay.
And you know, our basic value add is we've been there and done that a bunch of times, a whole bunch of times. And you know, I think typically they've approached us because they want a CEO.
Okay.
You know, there's the stereotype of the founder who, you know, must be the CEO. I think oftentimes the founder is saying, no, I want a CEO, I want to bring this to the next level, I want to get venture funding, etc. If we find a team, by the way, that is really well qualified, has got it all together, and they approach us often, we'll typically introduce them and help them meet the right investors, but we won't take the deal.
Right. Now, it's interesting. Well, first of all, what percentage of the company do you take after you raise the Series A for them?
Our target is somewhere between 8 and 10% of the company post Series A.
Okay. Wow.
Now, keep in mind that we don't think of it as raising Series A, and I want to make that distinction because our view is, look, good companies will have money thrown at them.
Yeah.
There's such a need to find good companies to invest in.
What's your role, having 8 to 10%, what's your role after that funding process? Do you still get involved? Are you on the board?
Yes. In fact, we're on the board of directors. We're often the chairman of the board of directors in the companies we work with, even when venture capitalists have invested.
Can you name some companies that you're involved in now? You're CEO of 3 companies, right? I
am CEO right now of, I'm trying to think if it's 3. I'm CEO of 2 companies right now. Yeah. So I'm CEO of a company called Sendio, which we're tremendously excited about. I don't know if you're familiar with it. It's an anti-spam, antivirus company. It's doing very, very well, growing 10% a month.
Yeah.
And you know, we're building out a team there. I don't expect to be CEO much longer.
Yeah. Okay.
And we've raised venture capital for that company in the form of a CEO. And when I made the distinction earlier, what I was trying to say is we're not money raisers. We're the CEO of the company.
Right.
And so if the company needs money, we get money. If it needs a strategic partnership, we do a partnership. If we need to sell more, we sell more.
Right.
But typically we do bring in a Series A. So Sendia is one of the companies. I'm also CEO of another company we're really excited about. It's called CyberRain.
Okay.
And this is a wireless, fully automated irrigation control. A green product. Save 30 to 70% of irrigation water use. It takes 15 minutes to install for a homeowner or a contractor, and away you go. So, and that would be typical of the kind of companies we work with.
So you're pretty broad. I mean, that's
very
clean
broad.
Tech, spam.
Yeah, that's one of the questions we get a lot. One of our backgrounds in consulting, you know, it's about pattern recognition. And in our view, startups have a lot of the same things going on, a lot of the same challenges, structuring, you know, governance, HR. When you get success, that's the point where you want a vertical market CEO. And so when VCs ask us, well, are you going to continue to be the CEO? Our message is, if you want us to. But the truth of the matter is, once we get Series A, we're going to have the opportunity to go out and get
other CEOs.
The right CEO.
Now, you're here because you're expanding this model. Correct me if I'm wrong. Can this scale? I mean, with like, it's kind of tough for you to be CEO.
It doesn't scale. It doesn't scale very well, and that's okay. I mean, you know. We're not looking to raise venture capital, so we don't have to make an argument, right?
Well, that's true.
What we're looking to do is create great returns,
to
build a brand around, you know, integrity and creating great companies. I think the way that it does scale is there are plenty of people that have really relevant experience in starting companies, and if anybody's been involved in a startup, they know how valuable it is to get somebody involved that knows what they're doing. And there are those kinds of people out there in Dallas, and in Washington, and in Chicago, and in Boston.
And you're taking that model.
Taking the model, and we can share funding, bridge funding. We can share our models. We've worked really hard to refine our modeling process and all the rest of the things. So yeah.
Does it work here? You and I talked about that earlier. Does it work in Silicon Valley?
We've been approached a number of times about starting an office up here. It isn't high on our priority list, and we think because it's a pretty good ecosystem up here.
Yeah.
If you've got a good concept and you're a good technology entrepreneur, there are lots of successful, I think they're called mentor capitalists, who are willing to get involved with you, invest some money, have been there and done that. So there's less of a burning need for kind of experienced entrepreneurs than there is in other places.
Okay. Well, on Vader, we've got hundreds and thousands of entrepreneurs. They might be pinging you, so
we're a great strategic partner for Vader.
Okay, great. They may be pinging you, so I just wanted to just warn you. So anyway, thanks so much, Matt.
My pleasure. Yeah. Thanks.
Good luck with your fund. I've been speaking with Matt Ridenour. He's the co-founder of Momentum Venture Management. I'm Bambi Francisco.